Now in this video I'm going to talk about the introductory lecture to the macroeconomics, where I will be talking about the measurement of the aggregate economy. In particularly I will be talking about the national income. National income accounting. So now, when we talk about the national income accounting, in this case we are going to measure the aggregate economy. So what we are doing actually is we are going to measure the aggregate economy. Now in this case I will not be just looking at it, look at the income from one sector, but however I will be looking at the income from the all the sectors of the economy and aggregating them in totality, whether it's a income or the expenditure. All these will be made aggregated, and then we will be talking about how what actually is the national income of an economy. Now, this is simply the measuring of an economic activity in an aggregate economy, that is, an economy as a whole. But before we begin with the national income accounting, we talk about a very first concept, that is the gross domestic product, also called as GDP. One of the important variable or one of the important number for measuring the aggregate economic activity. So now GDP is the total value of final goods and services produced in an economy in one period or in 1 year period. So whatever an economy is producing in a 1 year period is known as a gross domestic product. Now, if we divide up this gross domestic product, it can be divided into four basic expenditure categories. Now, the expenditure categories in which we can divide this gross domestic product will be like consumption, investment, a government expenditure, and exports minus imports. So, or we sometimes call them as net exports. Where X means the exports and M means the imports. So these four categories, if we total them, they are going to be called as a gross domestic product. They are we will talk about it in the other lectures, and we have to talk about each of these components separately. However, the four basic categories that are from expenditure wise, if we talk from the expenditure side, the four basic categories that go into the making of the national income or the gross domestic product, it is the consumption plus investment plus government expenditures and plus exports minus imports. Now, we are going to talk about that in a while in the next lectures. However, for at this point in time, I just want to make focused on the gross domestic product. That's the value for the final goods and services produced in an economy during an 1 year period. Now, the another concept that I want to talk about is that this GDP is a flow variable. Now, when I talk about GDP as a flow variable, I say this is the number or this is the final value of the goods and services or the final output of a country that it produces per year. So we measure this GDP continuously. Say for example, we can measure it quarterly, we can measure it annually. So in this case, this variable becomes the flow variable. There is another type of a variable that is known as a stock variable. Like say for example, like we have the balance sheet figures. Now these balance sheet figures, they consist of assets and liabilities at one point of time. So these variables, these are known as stock variable. However, in this case, the GDP is known as a flow variable because it's measured continuously, and this continuous measurement makes it a flow variable. Now, another important fact that I want to talk about in this case, this GDP measures the final output, but not the intermediate goods. So what we are going to measure is the final output of an economy, but not what is going to result in the what is going to be the intermediate goods that result in the production of this final output. Because if we measure both the final output as well as the intermediate output, there or intermediate goods, this is going to result in the problem of the double counting. Now we will be talking about the problem of double counting as well, but so far you need to understand that we are just measuring the final output of an economy that it is going to produce in 1 year period. So now next we are going to talk about the real and nominal concepts. Here we are going to talk about the real and nominal concepts. Now the real and the nominal concepts. Now firstly let me talk about the nominal output or nominal GDP. Now it is the total amount of goods and services produced and measured at current prices. So this is simply the what if we are going to measure this output simply by price into the quantity produced, we are measuring it at the current market price, then we are measuring the GDP as per we are measuring the nominal GDP where we are taking the current price into consideration. However, there is another type of the concept that is known as real output. In this case, it is the total amount of goods and services that is adjusted for price level. Now I just want you to hold the thought over here, and then we'll be talking about these two concepts. Now see, the country's output can increase by two ways: either the rise in the price or because of the rise in the output. So in both the cases, the country's output is going to increase. So because say for example, if I'm producing 100 goods and the price was say for example 10, it is going to be 10,000. Now the same 100 goods, and if the price is only 5, the total value of the output is going to be 5,000. So in this case, the output is same, however the price has changed. So these figures over here are nominal figures. However, when we adjust these nominal figures for the price level, they are known as a real output. In this case, we talk about what actually the economy is producing. So the real output of an economy is going to be equal to the nominal output divided by the price index, and price index we normally take the base year multiplied by the 100. Now you may be wondering what this 100 is doing over here. This 100 is just used to as a as a representation of the base year. Say for example the real output is 180. We said that it is an 80% increase in the output. Say for example if it is 70, we say there is 30% decrease in the output. So this 100 is just used to represent this base year. Now the next that we are going to talk about is the gross and the net concepts. The next one we are going to talk about is the gross and the net concepts. So let me write out gross and the net concepts. Now we had this GDP, and now I will be talking about the net domestic product. Net domestic product. Simply that is NDP. Now national domestic net domestic product is simply the gross domestic product adjusted for depreciation. Now what do we mean by this depreciation? It is simply the amount of the amount of capital that has been used to produce the year's GDP. You can say that's the amount of capital that has been used to produce a year's GDP. So say for example we used machines and there has been a wear and tear in the machines, and we have to subtract for that wear and tear. That results into the net domestic product. So if I just write it down, therefore the net domestic product is going to be GDP minus the depreciation. Or I can write it like this. I say it's called a consumption plus investment plus government expenditure plus exports minus imports minus the depreciation. In both ways you can write it. So this is my GDP and this is going to be my depreciation. Now the next that I'm going to talk about is the national and domestic concepts. But before talking about the national and the domestic concepts, just remember this, that when we want to move from this G figure to this N figure, sorry this is G here, from G to N, and DP and DP remain constant, we have to subtract by the depreciation. Now over here I am going to talk about the national and the domestic concept. Now I take this domestic product to the gross national product. Gross national product. So over here I'm going to write a sentence and I'm going to talk about it, that it is the output produced by citizens of the country. Now these citizens can produce something in the domestic territory or they can produce something in the foreign territory. Now in this case we have to add the if incomes that or the output that the citizens are earning or have produced in the foreign territories. In this case the GNP is going to be equal to GDP plus net factor incomes from abroad. So this is over here, net factor incomes from abroad. Now I'm going to open it a bit. It is the net factor incomes from abroad is the income from foreign domestic factor or we yeah, so it is the income that is the income from the foreign domestic factors. So whatever we are earning, whatever is being, whatever, say for example, if someone is renting his services outside, or if someone is producing the output in some other country, and that is since being the citizen of the domestic country, so we have to add it up to the to make to be called as a national product. In this case, we add up the net factor incomes from abroad. Now over here, the G&G remains constant. However, we are moving from domestic product to the national product. In this case, we are adding up the net factor incomes from abroad. Now another important factor that I want to talk about here is that if the domestic residents or domestic citizens are producing something in the foreign country, the foreign country citizens may be also producing something in the domestic country. In this case, we need to add up the whatever is produced by the domestic citizens in abroad, and we have to subtract from it the income that is earned by the non-citizens in the domestic country. Now let me take an example. Say for example, this is India and this is China. Now India will produce something as the GDP, and China will also produce something as a GDP. Now to move from GDP to gross national product, what China has to add is that whatever the citizens of China have earned in India, and they have whatever the citizens of China are producing in India, they have to add it as a net factor income from abroad. However, there might be some citizens from India who are producing in China, and they will add it to the domestic product. Therefore, there is going to be a netting, and that netting is known as a net factor incomes from abroad. So in this case, what we do, the India will add up all the amount of the goods and services that the citizens are producing in China, and it will subtract all the goods and services that China is producing in the domestic territory to reach to the gross national product. So net factor income abroad involves adjustment for whatever the foreign citizens are producing in the domestic country. It will be applicable to both the countries, whether India and China. If we take domestic country as in India, so India is going to add up the factor incomes that its citizens are producing in China, and it is going to subtract down whatever the Chinese citizens are producing in India to reach out to the gross national product of the India. Now let me talk about the methods of measuring national income. Now there are basically three basic methods of measuring the national income. The first one is the value-added method. And sometimes also called as product method. The second one is the income method. And third one is the expenditure method. Now we'll be talking about these methods. Now the first one that we'll be talking about is the value added method. Now what does this value added method actually measure? It measures the contribution of each producing enterprise in the domestic territory of the country. What it measures is the contribution of each producing enterprise we can also write an individual in the domestic territory of a country. Now in this case we have to first identify what are the producing enterprise, then we can classify them into the industrial sectors or as per the area of activity, like the tertiary sector, or primary sector, tertiary sector and the secondary sector. Then we can then just add them up. It's very easy. And then we have to talk about the what is the net value added by each producing enterprise, or as per the each industrial sector. So if we take up a producing enterprise, or add up all the net value added by the producing enterprises, we will get the value added. But in this case we have to take care of a concept called as double counting. We'll talk about that. And we have to also talk about the production or production for self-consumption, and also about the about the double counting, and we have to talk about the production for self-consumption. Now let me talk about this a bit. Now first, what do we mean by the double counting? Here we have to differentiate between the final good and the intermediate good. Now what do we mean by this final good or the final output? It is the final let me just increase the area. Oh. Now it is the final output that is or the final goods and services produced for final use. Now the next one is this intermediate good. These are used as input in the production of some other product. Now say for example, let me take an example over here. I have this farmer, then I have this miller, and then I have this baker. Now say for example this farmer grows wheat, and this wheat is taken by the miller to process it and to make it a flour, and finally this flour is processed by the baker to make it the bread. Now in this case, this flour is called as in this flour will be the intermediate good for this, for the baker, and the wheat is going to be the intermediate good for the miller. However, there has been what we are going to count. We are going to count this bread as the final output, or we are going to see how much output is being produced. What is the value of this output that is going to go into the GDP, or we are going to talk about the value added at each stage. We are going to we can also talk about from this side that how much is the value added from each of the side. Now, how much value is added by the farmer, how much value is added by the baker, and finally how much value is added by the miller, then by the baker, and then when he sells it to the final consumer. So in these are this way we can add up the value added, and then that will result into the final figure, and that final figure will be called as the GDP by the value added method. Now the another type, or the another thing that we are going to talk about over here is that the how do we actually reduce down the double counting, or how we actually eliminate a double counted. And now in this case we have to list down what are going to be the intermediate goods, and what is going to be the final goods. After that we can eliminate the problem of the double counting. Now let me take an example over here. Say for example, in economy there are there are individuals like A, B, C, D, and the final consumer. Now I will talk about how we actually calculate the total value added in an economy. Say if we will note down the transactions. Now then we will see the value of the output at each level. And then we will talk about the value of the input. And then we will be talking about the value added approach. Now see, the first case, in this case, say for example A sells to B. Say for example the goods worth 1000 and its value of input was 0. Therefore the total value that has been added to the economy is 1000. Now say for example B then sells the product after processing to C, and he adds up the 500 as margin, and he sells it for 1500. However, his intermediate good has been this 1000, so his good, this value of the input was 1000. In an economy, the total value added that has been added is only 500, not the 1500. Then they say for example the C sells to D. He again processes it and then sells it, say for example for 2200. Now his input over here, this 1500 becomes his intermediate good, so he's going to subtract it up, and it is going to result in the output increase by 700. And then say for example this D sells to consumer. He adds some margin on it and then say for example sells it for 3500 to the consumer. However, his intermediate good has been 2200. Therefore he is making a profit of 1300. 1300, yes. So for total value added, it is going to be equal to 3500. Now as if we can look it from this side or we can look from this side, in both the cases it's going to be same. If we talk from this side, like if we add the value added in this case, or we take the bread, final value of the bread, it's going to be the same. Therefore this is how we actually take into consideration the value added and remove down the double counting by taking only the value added into the economy. The next method that we are going to talk about is the income method, and then we are going to talk about expenditure method. Let me first take up the income method. Now in this case we'll be talking about the income method. Now the income method is In this case, say for example, we have the different factors of production. Now the different factors of production, they are pooled to make up the final products, make or produce the final products, or produce the final product. But for each of these factors we have to pay some amount of the or we have to pay out some amount of the we have to compensate them for their services. Or say for example, let us say for example, the factors of production as land, labor, capital, and the managerial services. So these, say for example, these are the factors, but we need to pay them the some amount of the compensation. Say for example, for the rent, for the land we are going to pay up the rent, for the labor is going to get the wages, and this capital is going to get, say for example, the interest, and the manager will keep the profits. So if we add them up, so this is going to be result into the total income, that is aggregate income, that is generated in an economy, and it is also going to be equal to the national income. And we sometimes say that the aggregate income is equal to the aggregate expenditure, or aggregate, say for example, aggregate production. By identity, this is going to be equal. The last one method, that is the expenditure method. We have already talked about expenditure components in this expenditure method. We just add up the consumption plus investment plus government expenditure plus exports minus imports. We'll talk about each of the components in detail. So if we add them up, this is also going to be equal to the this is going to be equal to the national income. So now by identity, all the three methods, the expenditure method, the income method, and the value added method, result into the same amount of the national income.